while we get started. So I just wanted to let all of you know, if 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 any of you are any of you here for some crazy tips about cryptocurrencies and bitcoins and all, let me save you the trouble. I am not going to talk about anything of that sort at all. So instead of you being disappointed that I did not talk about cryptocurrencies and bitcoins and how that could make you millions and billions, theoretically, I'm absolutely not going to talk about that. And this is more about the mindset that we should have while we are undertaking investments, what thought processes we should have, and how to evaluate investment opportunities. That's the more sustainable approach that I'm going to take today. Right, so it's not going to be about bitcoins. It's not going to be about cryptocurrencies. It's not going to be about stock tips. Once, Jagan, do you remember? I was actually invited to talk on a financial planning webinar, and this was predominantly for senior citizens,
Mm.
and all of them patiently listened. I think I had about 200 participants. Of course, it was not on behalf, it was on behalf of another large financial company. Yeah, and somebody at the end asked me, "Hey, you spoke very well, excellent, but I did not get any stock tips." And I was just not able to stop laughing because stock tips is not what I'm here to do as well. So that's something very important. Let me set the record straight. Excellent. Um, I know we have some diverse guests. We have some new guests as well. A few ones are seemingly new. So let me ask you this. Fastest finger first. Please use the chat box. How many of you have less than 10 years for retirement? And how many of you have more than 10 years for retirement? You have to say less than 10 years or more than 10 years or already retired. If you're already retired, you just say retired. Excellent. Okay. Thank you, Paddy. Thank you. Thank you for that. Have retired. Krishnamurti says more than 10. Annie says more than 10. Karupsa Misur says less than 10 years. Okay. Who else? What other options do we have? Please use the chat and help us talk to us using the chat so that we can use more relevant examples. When we ask. So the question, just we have a new joinee. So the question is, where are you in your retirement stage? Less than 10 years, more than 10 years, or are you already retired? You're not here just for the sake of being here. You've invested your time, so might as well participate and make the best of what we are going to do. There is not going to be any presentation. If there are some images that I want to show, which I will use when I'm going to show. Otherwise it's you, me, and the wonderful Zoom. Okay, so we have quite a mix. We have an equal of retired. We have an equal of more than 10 and seemingly less than 10. So we have a mix of everything. Now, while thank you, of course, thank you for responding. And while I ask you, and this response will change to each party, right? Uh, just guess. How much do you think you need for retirement? 1 crore? Less than 1 crore? Between 1 to 3 crores? Or between 3 to 5 crores? Less than 1 crore? Between 1 to 3 crores? And then 3 to 5 crores? How much do you think you need for retirement? Hmm. Annie says, okay, we have some. Uh, Sangeeta says 5 to 10 crores. Excellent. Thank you very much. Annie says 25 times your current cost of living. 25 times your current cost of living. Okay, that's a good one. Thank you. Krishnamurti ji says 3 to 5 crores annually. Yes, got it. And Karapsamy sir says 3 to 4 crores. Jagan says 3 to 5. Paddy says 10. And so as you can see, these responses are very unique to each of us. That's the way retirement also is. It is unique to each of us. What goes through in my retired life is not what is going to go through in Jagan's retired life. What is going through in your retired life is not what is going through in the retired life of your friend. Yeah. So what is very important here is we stop assuming that what's important for somebody else is important for us. What's important for us is important for somebody else. No, it's not going to be that way. And the one singular secret that I can share, why I asked this question is because there is a very important message behind the question. And that message is to have a larger retirement kitty, is to have a larger retirement kitty. The topic of this program is the expenses are rising, the interest rates are falling down. How do we match? Yeah, that's the topic of this program. One of the things obviously we should do is to have a larger retirement kitty. Now you may say, oh, this is very easy said than done. So let me expand when I say we should have a larger retirement kitty. How many of you are aware of, okay, instead, I'll just right away show what I want to show. Okay, I have, yes, I think you're able to see. And yes, I think you're all able to see a very small image which says, the life cycle stages that we have. So typically, wealth goes through three very important cycles in our life. The first is basic wealth protection, where we are just trying to protect whatever we have. Some pocket money that we receive when we are very young, so on and so forth. Then in stage two is where this is the largest of all stages, which is called as the wealth accumulation stage. Now, wealth accumulation happens by two ways. One, we add more wealth to the portfolio by earning more, by saving more, so on and so forth. And second, very, very, very important way is to allow our portfolio to increase in size by the way of compounding. Okay, this second way is something that people don't talk very often. People don't realize that that is extraordinarily important, and this aids significantly in our wealth accumulation phase. Uh, we have limitations in our earning capacities. We have limitations in our savings capacities. But with wise investment decisions, we can let our wealth compound. We can let our portfolio compound either faster or at a higher rate, whatever it is. That will lead to a higher retirement kitty, right? That's very, very important. And you know this is how the whole phase goes. We move from the planning phase or the protection phase, so we call, then we move to the accumulation phase. Typically in India it lasts somewhere between 30 to 40 years, and that's why there are retirement the retirement age is 60, 58, 60, because people can work between 25 to 60, which is roughly about 35 years. The concept of early retirement, the concept of retiring at 45, at 50 is more recent, inventions of the 2000s. And then comes the distribution phase. The distribution phase lasts for about 25 to 40 years. Actually, now the life expectancy is a lot more higher. So it doesn't last just 25 to 30 years, but anywhere between 25 to 40 years, the distribution phase lasts. And I say 40 years because the distribution phase cannot last only for you. It also has to last for your spouse, right? So it's like interdependence. We'll have to make sure that whatever we have lasts not only for us but also for our spouse. And that's the distribution phase where we want whatever we have accumulated, it should surpass the distribution phase so that we can give or we can leave a legacy for our family members, for our kids. It should surpass. But in India, it's typically the other way around, where we first give and then we make do with whatever balance is available. But yeah, that's just how we culturally are. But that's okay. And what's of mission criticalness here is that we start early. Now, many times people ask me, okay, how do I have a larger retirement kitty? Three secrets. How do we have a larger retirement kitty? Three secrets. Start as early as possible. I know a lot of you people, you know, you've already started. So this may not be for you, but even if you have not started planning for retirement, start as early as possible to plan for retirement. Start as early as possible to not only just increase your income, to not only just save more, but also start multiplying your wealth, right? So that's one. Second is very important aspect is to choose equity. When we say equity is the most versatile asset class that is ever available to mankind. And a lot of times people end up losing money by looking at equity in a wrong manner, and people lose a lot of money, but that's not the way of how it is. It should be. It is the most versatile asset class for mankind to make money in today's world. So we should look at equity, and we should invest so that it compounds. And here, when we talk about wealth accumulation for about 35, 40 years of all of these phases, where people go wrong many times is they'll invest for 5 years, they'll invest for 6 years, 7 years. Once they have 50 lakhs, 60 lakhs, 70 lakhs, they'll withdraw all of that money, right? Just when it would actually start compounding. Just when it would actually start compounding, people would just withdraw from that and put it elsewhere. And that's why that's why a lot of wealth does not compound, because we don't allow the time that is required for it to multiply. Making money is a game of multiplication, right? You put money in fixed deposits. You know the rule of 72. I hope are you aware of the rule of 72, guys?
Akash, just explain. No?
Yeah, this the rule of 72 is, if you divide the interest rate, yeah, by 72, you will get to know how many years it is going to take to double the money. If you divide the interest rate by 72, that is the time that it is going to take to double our money. So I'll show you an example. Now let me just share my screen and I'll show you an example. Yes. So the rule of 72 is something like this. I hope you're able to see. I have zoomed in. So let's say we have an interest rate. Can somebody tell me an interest rate that you're experiencing? Anybody? Anybody just type out an interest rate that you're experiencing? 3%, 4%, 5%, 6%, 7%, anything,
Six
whatever
to
that.
7%, sir.
6 to 7%. Excellent. Thank you. So I'll take 6% and then I will also take 7%. Yeah. So yes, so 6 divided by 72. So this much is the time that it is going to take for um, okay, so it's actually the other way around. So let's say if we want our money to double in 6 years, then it is going to take 8.33% to of interest rate for us to get. If we want our money to double in 7 years, then it is going to take 9.77%. So this is the very simple rule of 72. How much time it takes to double our money. And and this is why what we should do is I'll give you one more example. Somebody said SSA. I think that's Sukanya Samruddhi account is what you're meaning. 100 rupees. Let's talk about a lakh. Yeah. Let's imagine an inflation of 7%. This is the retail inflation. 7% is nothing. So 7%, let's say 7 years later, so you can see at the rate of 7%, we will the value, whatever I spend today for, whatever I would spend today for 1 lakh rupees is going to cost me 2 lakh 10,000 rupees at the end of 11 years. Can you see here at the end of 11 years? This is how money loses its value. What goods can I buy for 1 lakh is going to cost me 2 lakhs at 7% inflation rate in 11 years. So it doubles. Our cost of goods double in about 11 years. Now you look at a fixed deposit. Yeah. A fixed deposit which you have put in, let's say, 5 lakh rupees, and it is earning about 7% every year, and you want it to double. Yeah. So let's see, how much time do you need? 5 lakhs. Let's say we want to double it to 10 lakhs. It is going to take 10.24 years for it to double, right, at 7%. What if it is going to what if the interest rate that we are going to get is 8%? It's going to take 9 years. What if the interest rate is 9%? It is going to take 8 years. 10%, it is going to take 7.2 years. Right. So this is the impact of how the compounding works. And wealth is really a game of how quickly we are able to multiply our money. So when we talk about equity investing, we are looking at about 14%. Yeah. And when we are looking at 14%, what happens is that the money doubles in roughly 5.5 years. So where is 10 years and 10 and a half years and 9 years, and where is 14 years? I mean, where is 5.5 years? I don't advocate all of our money to be in equity, but equity should definitely be a consideration for us, because I see when we do a lot of portfolio planning, equity is not at all a consideration for a lot of people, and it should compound this way. Are we good until now? Do we have any questions until now, please? So what I tried to explain to you is this one aspect of how much do we need retirement for our retirement. Many times we underestimate what how much do we need for our retirement. Point number one, and the underlying thing there was to have a larger retirement kitty, for which there are three ways of how we could have a larger retirement kitty: save early, choose equity, and invest so that it compounds. Mr. Karpsamy says, please explain equity. So what is equity? Equity is nothing but participation in the stock market. That is what is equity. It is an asset class. Do I advocate that you buy do I advocate that you buy stocks directly? No, I don't advocate that you buy stocks directly. Buying stocks directly is one way of participating in equity. But there is another extraordinarily good way of participating in equity, and that is by investing in equity mutual funds. What happens in an equity mutual fund is that you just invest in the mutual fund, and the mutual fund appoints learned professionals who will handle your investments, and they will undertake what mandate the fund house has, and they will undertake the investments, and they will make profits for us, right? And that's the power of investing in mutual funds via in equity mutual funds. You have professional advice. You are not exposed to extraordinary risks because you are not doing the buy and sell decisions. And they're really good people who are trying to do extraordinarily well. Of course, it is volatile for the short term, but in the long term, it will make money for us. So that's in a very short way of how I could explain equity. I do not advocate direct equity. I do not advocate any of you trading directly because I said so. No, not at all. Even if you have money, even if you have experience, uh, my suggestion is don't do direct equities. We are not capable enough to win in the market. The best way is to be an investor in equity mutual funds, and to take the right advice, and invest and remain invested. Let that money continue to compound. Let that money continue to grow, and make wealth for us. Is that good enough, Karpsami sir, until now?
Akash,
Yes, sir. Yes, sir.
Yes.
Okay, sir.
Thank you. Yes,
Akash, there's one more question from Paddy.
sure.
Why is time period told in percentage units?
Why is time period told in percentage units? Was that a part of the formula?
Yeah, I think so.
I think that was a part of the formula, and I'm sorry if I meant it incorrectly, but that's not how it is. As you know, time period is always n per, and n per is in units of years. That's how it is. Thank you.
Akash,
Jagan?
I have a question to you.
Yes.
I still remember when I was in school, my dad used to put in post office Kisan Vikas Patra. So it doubles in 5 years.
Yeah.
But now, say before COVID, when I went, they said it is 7.5 years
Yeah.
to double. Now,
Jagan, don't. That's my next thing. Please don't talk about
okay,
it. Don't let the goose out, Jagan.
okay, since you're talking about all these things, no, like,
Yeah, 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 yeah. Yeah,
okay,
yeah. I know you are always the curious, inquisitive person who wants to know what's coming next. That is exactly what's coming. And thank you for bringing that up, Jagan.
hmm,
Um, so just to follow up what Jagan said, right? Let me show. Um, how many of you agree that interest rates are going down? And I'm not talking about, and I won't share my screen until you post, because then, yeah. Okay, so one gentleman has said interest rates are going down. Who else agrees that interest rates are going down? Jagan has already told that interest rates are decreasing. Yes, so we have this phenomenon where interest rates are decreasing, right? I just took a small statistics. This is the SBI fixed deposit interest rate over a decade. Okay, just over a decade. I didn't even take 30 years time frame. Just over a decade. If you see from 2013, it has come down, it has come down, it has come down. and it's not reaching back again, right? If you look at the time periods before this, it was a little higher. There was a time. How many of you remember? If there is somebody old enough, they will remember there was a time when we had double digit interests on fixed deposits. Do you know, Jagan? Double digit interests on fixed deposits.
No, gosh, I don't remember.
Yeah, I do remember. They were also there on post office schemes, double digit interest rates, right? And when we talk about these double digit interest rates, what happens is this is the world that we are living in as our economy. And this is very important for you to understand, because most of you are either retired, or some of you are going to retire in the next 10 years, or some of you have more than 10 years to retire, and you should fundamentally understand the economics of the economy of a country and the interest rate of that country. So as our economy improves, the interest rates reduce, right? As our economy improves, the interest rates reduce. That is why if you look at modern economies or advanced economies like US, like Europe, like Australia, right? The interest rates are 1%, 2%, 2.5%. Some countries in the Europe, actually, you have to pay money to the bank to keep your money there. They won't pay you any money at all. You have to pay them money for holding your money, right? So as India's economy goes up, up and up, which is how it is going to go for the next 30, 40 years. What is going to happen? Our interest rates are going to go down, down, and down, just like how you're able to see in this graph. Is it going to become 1%? No, it is definitely not going to become 1%. But is it going to come down significantly? Yes, it is going to come down significantly. And that is going to be a shocker for us, right? And I'll tell you the reason why. Let's say you do your retirement planning today, and you say that there is somebody, I think Amy or Paddy or somebody, who said 25 times of our adjusted income we will require. Beautiful statement, right? So when we do those adjustment calculations, we are considering the retirement, the interest rates of the current interest rates, right? Probably 2025. But when we are going to retire in 2035 or 2040, the interest rates would have got reduced. And that's the biggest risk all of us face, that interest rates are definitely going to go down. Fixed deposit rates are definitely going to go down. How is it that we are going to manage? What are we going to do? Jagan, did I hit the point right? Was this your question?
Yes, exactly.
Excellent. Thank you. We both are co-founders for a reason. You asked the question, I have the answer ready. So, while I showed this graph, there is another interesting graph that I would like to show. Our country has its checks and balances. Our country has its checks and balances. Our country knows that senior citizens are not taken care properly because we don't have a social security system, right? And that would be just very, very, very expensive on the government. So the government has something called as small saving schemes. That is what Jagan was mentioning, and a few others were also mentioning. How many of you have heard of something called as public provident fund? All of us have heard, right? And you see how the public provident fund has acted as against the interest rates that have gone down. How has the public provident fund worked out? It not as bad, at least, as the interest rates. Not as bad as the interest rates, at least. Yeah. So this is how the interest rates have been from 1968 to 2023. Of course, they went to double digits. I was telling Jagan briefly For a period, they were at 12 and a half, 13%. Yeah, for a very brief period of time. For about 10 years, they were above the 10% mark. And then, it started adjusting to the economy of our country. But but are we using these kind of schemes that are designed for long-term interest? Are we using them appropriately? That's the question that I have for all of you. Right? We many times what I have experienced is people look at fixed deposits. What else do you look at? Let me ask this question to the audience out here. What else do you guys look at apart from fixed deposits? What else do you look at? Oh, there is an interesting question. Sangeeta asks, so you mean to say we shouldn't manifest India to become an economically developed country? No, that is counterproductive, right? Definitely, we should manifest India to become an extraordinarily economically developed country. But what we should also do is we should not expect the same interest rates to continue 10 years, 20 years, and 30 years down the line. So that is what I was meaning. Yeah, we have some examples. Karpsami sir says recurring deposit, again short term. Krishnamurti says gold, 50-50. Shanmuga Priya says land, too higher, cost. Land doesn't, unless you construct a property and then you get rental income, it has only capital appreciation. But yes, good. Real estate is there. Yes, absolutely. Annie says mutual fund, SIP, stock market, few fixed deposits, PPF. Excellent, excellent. Thank you for your responses. So if you see what emerged, what significantly emerged is one, land, real estate. Second, somebody said gold. Third, everyone said fixed deposits. Fourth, a few of them said mutual funds, and the fifth was PPF. But there are quite a few more, quite a few more. Yeah, and how many of you want to know? Jagan, do you want to know?
Yes, definitely.
Excellent. Now, when I say this, you should understand that there is a very important distinction between short-term interest rates and long-term interest rates. People end up only making the comparison on the short-term interest rates. Hey, this fixed deposit is giving me 8.5%, sorry, 8%, and the duration is 444 days. Yeah, versus a PPF which is giving you 7.1%. Which one would you choose, Jagan?
Uh,
No. You should actually tell the one that you end up choosing.
the first one.
The 8% which gives for
Yeah.
triple 4 days. But shall I tell you something, Jagan? What is going to happen? PPF is a product for 15 years,
Hmm.
and then extendable by 5 years. So it's a long-term interest rate product for 20 years. Yes, of course, the interest rates do change depending on what the government announces. But as a investment vehicle, they know that it is used for senior citizens. So historically speaking, PPF interest rates have not worsened. But that FD that you're going to take after 444 days, right?
Hmm.
In 20 years, it is going to have roughly about 15,444 days. And 15 times it is not going to give you 8% for sure. What is going to happen? The image that we saw before is going to happen, right? So they may give you 8% now, but then the next year it will be lesser, and then the next year it will be much lesser, and then the next year it will be much lesser. And this is where a lot of retired people lose, because they make short term decisions based on the interest rate. Whereas we should let go of a few basis points. A few basis points meaning we should balance our short-term interest rates with our long-term interest rates. Is that a fair point to make, Jagan?
Yes, Akash. Because like what you have told, I've already experienced it.
Uh-huh.
I put two
And
FDs.
yet, and yet, you decided that you will put an 8%
Yes,
triple four days.
I always believe in what you call, okay, next time will be better.
Ah.
So because once it happened, like
Mm-hmm.
I put for a lower interest rate, but I put it in for a 3 years period, some 36 months, something like that. We put it.
Yeah.
Then immediately after 6 months, the percentage was raised.
Yes. And unlike home loans, they don't raise the percentage of fixed deposits. Once we are taken and locked, it's
Yeah,
locked.
that's what I got locked for 3 years.
Yeah. 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 Yeah, so long-term products is something which is very, very important that we should consider. And what is better than some of the post office savings schemes for long-term products? There are five iconic schemes of the government of India which are designed for retiring or retired people. Five iconic schemes of the government of India designed for retiring or retired people. And here I show them. And I'm using real websites. I'm showing exactly what is there right off the government website, because I don't believe in changing and doing all of this, right? So this is exactly what you're going to get. How many of you have heard something called a post office monthly income scheme? 7.4% per annum payable monthly. 7.4% per annum payable monthly. A post office monthly income scheme. Government's iconic answer for retired people. The first answer is POMIS. You may say, okay, there are limitations of how much we could invest. Yes, there are limitations of how much we could invest, but are we investing to those limitations? And those limitations are always into two, because we can take one and our spouses can take another one. Yeah, 7.4% per annum. The next is senior citizens savings scheme, which is 8.2%. There is nothing that gives 8.2% right now. Nothing. No fixed deposit gives us 8.2%. Of course, there may be some which gives 8.5 for senior citizens, some um, corporate deposits which give a little more than 9% as well. But on a sovereign guarantee, 8.2% of senior citizen savings scheme, we don't get. So these are all answers for long-term interest rate lock, right? You invest in these kind of products, and then a part of your portfolio should be focused on long term, right? Even post tax, they make sense. Even post tax, they make sense. Not only pre tax, post tax, they make sense. PPF is a super product because PPF's taxation is zero. There is no tax on PPF. So literally you get every rupee of the 8.1% compounded. So sorry, 7.1% compounded per annum, right? This is after tax. 7.1% compounded is after tax, right? And let me show you how it works. So we are talking about let's say your PPF kitty is roughly about 10 lakhs, right? And the interest rate is 7.1%. And after 10 years, what is it going to become? 10 years, PMT, is 10, 0. Can you see? Jagan, can you see?
Yes, Akash.
It's doubling in 10 years. And every rupee of this 19.85 lakhs, which is roughly about 20 lakhs, you get no taxes are owed to the government. No taxes are owed to the government. So that's the power of these mix of long-term and short-term schemes, of course. And I'm also a big proponent of. I think you were talking about this, Jagan, Kisan
Ah,
Vikas Patra.
yes, yes.
Yes, the amount doubles in 9 years and 7 months.
Oh, it's gone up to 9.5 years. Oh,
Yes, earlier I know it used to be 6.5 years, 7 years.
Akash,
7 years
I,
became
I,
seven and a half.
I've signed the certificate when it was 5 years. I remember,
Hmm.
but yeah, I think I was in 11th, so that was
I
some.
was going to say that time you would also have been 5 years.
No, no, no. It was in 1989, 90 period.
Yeah, but currently it's nine years and 7 months. See, so guys, a very important point is in 2025 you sign a KVP, right? And that doubles in 9 years and 7 months. Nothing is going to happen in 2026. The rates are not going to change in 2027, 2028, 2029, 30, for 31, 32, 33, 34, 35. Right? But can you guarantee the same thing in a fixed deposit? No, you can't guarantee the same thing in a fixed deposit. The difference between KVP and Public Provident Fund again happens to be the taxation. KVP, the growth is taxable, whereas Public Provident Fund, the growth is non-taxable. So PPF is still better than KVP if you are on the tax bracket.
Sir, one doubt.
Yes, sir.
Actually, sorry.
Yes,
Sir,
please go on.
if you are trying to invest in post office schemes, it is little bit bottleneck. The pay staffs engaged and the money you have to deposit and take out, they are still not uh, updated to their new trends, sir. If you are
I
going
agree.
into a post office and ask for something like this schemes, they are very reluctant to deal with this.
Absolutely,
Probably
absolutely.
we are facing, and
Can,
they
can
need
I
a
give
home
you can I give you an
also. Sir.
extraordinary news today?
Yes, sir. Thank you.
For none of these, you actually have to go to a post office.
Okay, okay. It's coming on
All
online, sir.
of these schemes are now available through all non private banks, which means all public sector banks allow you to invest in PPF, allow you to invest in senior citizen savings scheme, allow you to invest in one more. PPF and senior citizen savings scheme, you don't have to go to the post office at all. Even POMIS, I think SBI and all of these mainstream banks have. Isn't that a great news?
Yes, sir. Yes, sir. I think we can try for that also. We should
Yes,
go on online platforms. You mean to say? Okay,
online,
sir.
absolutely online platforms. Yes,
Okay, okay.
very
Thank you,
much,
sir.
very much.
Thank you for your clarification, sir.
Yes,
Akash,
some
I
some some
Yeah.
time deposits, like for example, the time deposits of post office, they give 7.5%. They are still with the post office. Then there is one more, KVP is still with the post office. But I think NSC has been decentralized, which means we can apply for NSCs even through public sector banks. I think so. I'm not very sure. But KVP, time deposits, and NSCs are still with post offices to the best of my knowledge. Jagan, you were saying something?
uh, yeah, that's what I was about to share my experience with the post office because what happens is what I've seen is like the people keep shifting, and the person sitting in the counter doesn't have knowledge about these schemes. You go
Yeah.
and ask them, they'll put you onto the postmaster, somebody senior in the department. That is what I've
Yes.
seen. Only the head post
Yes.
office have the separate department as such. All the other location post offices they don't have the right person.
Yeah. True. Sometimes it is a little difficult, right? The services are not very organized. But yeah, if If that's going to, earn us a few bucks, might as well find a way to get there.
Yes, and mostly like with the central post office and head post office, like the service is good. There are people like private banks sitting there, like executives. You go there, you talk to them, they help you out in a lot.
It
But
does.
that is happening in only the selected post offices.
Absolutely. Absolutely.
Akash, we got two sharings the chat box. Suvash
Yes.
Mogopriya says,
Shivash, Shivashanmugapriya says, EPF voluntary provident fund interest rate is high. Absolutely. See, PF interest rate is the best. 8.25% is unheard of. Sovereign guarantee. It's beautiful. Don't remove your money from EPF. Is what I would say. It has zero tax. Keep it until the last day. That is after contribution. You can keep it for 36 months. So keep it until 35 months, 35 and a half months. That is what I would say, because 8.25 without any taxes is a beautiful way of investing. Of course, it is completely risk free, right? So risk free, that's the only highest earning. Other factors, higher the risk, greater the return, of course. Thank you for sharing that, Vasant. Liquidity is there, taxation is there, safety of the capital is there. Absolutely, absolutely. So true. And thank you for sharing that. Thank you for sharing that. I will also ask all of you the next question. Let us imagine that you all wanted to go to Delhi, right? Let us imagine that you all wanted to go to Delhi. I give you four options. You have a self-driven car, you have a bus, you have a train, or you have a flight. Which mode of transport would you take? Which mode of transport would you take to go to Delhi? And this has nothing about the money that you have, so on and so forth. So just feel free to respond, whatever you feel like. The flight, there are a few people who says flights, train, flight. There is no right or wrong answer, as I mentioned. Jagan, are you typing your response? I don't see you typing your response. Oh. Hmm. Train. Okay, excellent. Jagan is train. I know. Yes. So see, and that this is a beautiful question, right? Imagine, Jagan. Imagine I give you another scenario. Yeah, it's train for you right now, right? But imagine you are in your mid 30s. You have a busy life. Okay, you have back to back engagements, and at that point in time you have to go to Delhi. What would you do?
flight.
You'd fly, right? And all of those who have mentioned flight, imagine, 10 years later, you are retired, you have just so much of time on your hand. You don't know what to do with the time. What would you do? Would you choose the flight, or maybe you will think of choosing a combo, right? Or maybe you'll still choose the flight. But what I'm trying to say is, at different times of our life, we choose different modes. And I'll repeat that again. Please listen very carefully. At different times of our life, we choose different modes. Yeah. The same way, at different zones of our life, we should use different asset allocation methods. At different zones of our life, we should use different asset allocation methods. And when I say different zones, I'm talking about I showed you the planning zone, I showed you the wealth accumulation zone, I showed you the wealth distribution zone, and then I also showed you the legacy zone. Right? These are all phases of life. And while the destination is the same, that we want to experience financial freedom, that I don't want to have shortage of funds as much as possible during retirement, so on and so forth. Um, but then the modes we should use are different. So in that similar manner, we should make sure that we have a bit of exposure to equity through equity mutual funds. And I'm a very big advocate of equity mutual funds. I myself, have clients who have put in close to 200 crores in equity mutual funds, and that's quite a lot of money for me to manage. But then I have seen people just getting so rich by investing 5,000 and 10,000 rupees and forgetting about it. For years and years and years, it has just multiplied and multiplied. And the time is not over. In fact, the time has just begun. We have another 25, 30 years where all of this is going to continue. India's economic story is one of the best of the world, and definitely equity is something that you want to consider. Of course, depending on your life stage, you should consider how much percentage should you put in 10% of your total assets into equity mutual fund. Should you put in 20%? Should you put in 30? Should you put in 40, 50? 60, 70, whatever it is. So that's very, very important, something that I wanted to share with you today. So there are three key messages that I have shared. Key message number one is, please plan for a bigger retirement kitty. And when I tell you that, you may ask, okay, how? It's very easy to say, Akash, you want me to plan for a bigger retirement kitty. I'm telling you the answer. Start early. Let your money compound. Let your money compound and choose equity. Right. So this is key learning number one. Key learning number two: understand long-term interest rates. Always don't end up choosing the short-term interest rates, even if they are higher. Balance between the long-term and the short-term interest rates, right? Because you are going to live 15 years later, you are going to live 20 years later, and you are going to live 25 years later. And at that point in time, the interest rates are going to go down. So we should make sure that, we are balanced. And the third, very important, is at different times of our life, we choose different modes, right? So depending on where you are, depending on your personal preference, depending on advice from qualified professionals, do look at equity mutual fund, which will help you compound your money, and that's one of the best things to happen for the mankind, and I'm a great believer in that. I will open up the floor for questions now.
Akash, I'll take the first question because I was holding back that question. Like the first slide you
I
showed,
know,
no?
I know. You went 4 times and came back. I know. Huh? Yeah. Go ahead.
The first slide, can you make it a bit simpler?
First slide.
Yeah, that different phases, accumulation.
Ah, yeah.
That
Yes, I will go to the first slide. This phase, right?
yeah. Can you show
Yeah.
me the previous slide?
This one.
Yeah,
So you can see here, this is our age. This axis is our age: 0, 20,
yeah.
30, 40, 50, 60, 70, 80. Typically, there are three phases. The basic phase starts somewhere between 20 to 30, right? Which is the wealth protection, where we create wealth, but we want to protect it because it's our hard-earned money. And then we enter into an accumulation phase where our wealth starts multiplying, or should start multiplying theoretically. Yeah. And then we move to a distribution phase. A distribution phase is where the wealth starts coming back to us in terms of monthly installments, in terms of monthly SIPs, whatever is the method. And also distribute to the charity of your choice, distribute to your children, distribute to your family members, whomever you think are deserving of your wealth.
Thank you.
Yes.
I got it.
Thank you.
Yeah.
What's your next question?
Not my. I think Karpsami ji has got one.
Yes, please. Karpsamy sir, go ahead.
Sir, in this scenario, in this case, how about mostly you are told about only equity and other savings scheme. How
Yes.
about investing in an apartment or a own house? Generally, we are in middle class family. Whether it is recommend to pay rent and move along the life, or pay EMI and develop or make an asset in an apartment or something, to what extent it is valid, sir? This is mostly this generation of people, coming generations will face it, isn't it?
Absolutely,
What's your
absolutely. And when we say, when we talk about asset allocation, what you're talking, Karsami sir, is about asset allocation, right?
yes, sir.
How much of my money should be where?
Uh,
So the asset allocation has five assets where we should have our money. One is equity, as we all know. Second is debt. Debt is interest bearing instruments. Okay. They are like fixed deposits, PPF, all of these are interest bearing instruments. The third is gold. The fourth is real estate. And the fifth is bonds. Yes, sir. So when we talk about real estate, there are two kinds of real estate. One is an emotional real estate, and the other one is investable real estate. Our first home, it could be worth few crores, but it is an emotional real estate. We will never sell it. Am I right, Karpsami sir?
yes,
We
sir.
can
Yes, sir.
flaunt around. Yeah, my home is worth 5 crores. My home is worth 3 crores. My home is worth 4 crores. But we will never sell it. Because culturally in India, we need a home. It's deep driven into our culture. Investable real estate is different. Investable real estate is where you invest for the sake of investments, so that you can, make a rental income out of it, or a capital appreciation out of it. That is what we call as investable real estate. You should definitely have investable real estate for sure. But should all of your money be in real estate and nothing in the rest four? No. You got it, sir.
Yes, sir. Uh, to explain this further, what would be the share that should be allocated to each of these things
Excellent.
in every stages for
Excellent,
up
sir.
to 30 to
This
40 years,
yes, I
50 to
will.
60 years until then? It
Yeah,
would be useful for us, sir.
there is no one thing fits right.
Okay.
One formula fits right stuff.
Yes, sir.
Nothing of that sort. But let me give you a ballpark. Let's say somebody, yeah,
Broader opinion, sir.
somebody
Okay.
who's between 40 to 45. Okay, 40
Okay.
to 45. They should have 5% in debt and 5% in bonds. They should have about 30 to 35% in real estate. They should have about 10% in gold, and the balance about 40 to 45% in equity. But this is very personal. I'm just giving you a very big number.
Yes, sir. Got it, sir. It depends on the age factor also,
It,
isn't
it,
it?
it a lot depends on age,
So
because
individually, okay.
let's say I'm changing this to 60 to 65. Okay, what is going to happen?
Yes.
You cannot put money in equity.
Ah,
45% you cannot have in equity, because equity is volatile, right? So
ah,
this will come down to, let's say, 15%.
okay, good.
Yeah. And what
Hmm.
will happen? You need more money in SCSS, in fixed deposits, in all of these things,
Ah,
which
okay.
can give you regular interest.
Okay, okay.
So the money will increase here in your debt, right? So
Okay,
there
sir.
there
Okay,
it will become 45%.
okay.
You got it, sir.
Yes, sir. Yes, sir. Yes, sir.
Happy to talk to you, subsequently, if you need any further questions, right?
Okay, sir. Okay. I'll come back, sir.
Thank you, sir. Thank you.
Thank you, sir.
Excellent. Any other questions, please,
You
Pradeep?
got something in the chat, Akash. Pradeep
Yes,
has
Pradeep
asked.
Kumar says, I'm a fixed deposit person. I run for 7 days FD on all of my leftover expenses and keep renewal. Even e- even renew. Sorry. is small but felt safe. Do you suggest MF can also the best option for small money for short term? In fact, now, Pradeep, I will say open an account with these small finance banks, right? They are offering 7% interest rate, savings bank interest rate, 7%. Small finance banks, and up to 5 lakhs, keep money there. You don't even have to create FDs. Just maintain balance with them, they'll give you 7%. Don't even go to mutual funds. Of course, mutual funds, equity mutual funds are not good for 7 days. They are only good for 7 years and beyond, right? But we do have something called as liquid mutual funds. But even liquid mutual funds won't give you 7%. But small finance banks will give you ESAF, Ujjain, all of those are there. Up to 5 lakhs is anyway insured. Yeah, exactly. SFB. What is SFB? Small finance bank, is it? Which? Anyway, so you are anyway getting 7%. There is no FD which is going to give you more than 7%. Yeah, AU Bank. Exactly. So just stick to that. You get 6.57%. It's excellent. So you should be, thinking of all this. It's very dynamic. Money making is an art, and once you learn the art, it's a beautiful science that you can practice. And why I say this example of art and science is because it is both. Yeah, excellent. Thank you very much. I think I've taken 5 minutes beyond my scheduled time. Jagan, do you want to
Yes.
do the closing?
Yeah. Yeah. Okay. Paddy has got a question.
Uh-huh. If we want to consult with you, how do we do that? Jagan, you have to answer this.
Yeah. Akash is in the group. You can text me. I'll text you his number. And initially, like Akash is the co-founder of Stay Active Movement 4075. So we started about approximately 2 years back. We did a lot of research, and we came out with this concept of 4075. And all our programs which are happening online are totally free programs. And every Tuesday, me or Akash, we take over different topics. So thank you for joining with us. And uh, Akash, I think we can share the link of the WhatsApp group for the new members.
Oh, yes. Yeah, doing that.
And we also run short programs like say like coffee table activities, things like that for senior citizens. So those in-person programs are chargeable, and we run this for various communities like apartments, and we also run weekend breakouts, all those kind of things, which we have not yet promoted in this group. Our only focus is this is what we are giving back to the community, because what we have gone through in life, we particularly with the experience and the exposure to the senior community is what has made me today what I am. I uh, had a retail pharmacy for 5 years in a retirement area. I'm from Coimbatore, and I had my retail pharmacy in Vadavali. That is where I experienced all these first-hand difficulties with these senior citizens faced. So that is the reason why we started this, and we are going great. Our friends, we have shared the WhatsApp link for our community. Please click on it and join, and we will be sending you our regular communication. And my number and Akash number are always there in the group. You can message us in a private window. We'll get back to you, whatever it is.
Jagan, Paddy has asked, will you share details of upcoming
Paddy,
in-person
yeah,
meets?
Paddy, you were here with the last session, right? Like I shared the WhatsApp group. We always put the communication on every Sunday and Tuesday morning for the for every week's program.
No, no, my question was in case you're going to have a in-person meeting or some kind of a workshop, then
Yeah.
that also will be posted in the group?
No, we see till now we have not done that,
I
because
see.
we just wanted to keep these two things separate. What is for the community, we wanted to keep it for the community. Our
Okay.
giving back.
Yeah, so
Yes.
Jagan, shall we add Paddy to that list where we can send information
Yeah,
about
we can
Yeah,
do.
please
in-person
do add
conference?
me because I'd be
Will do.
interested to come for in-person meets and workshops
Excellent,
and stuff.
excellent. Will do,
Thank
Paddy.
you.
Yeah.
Thank you.
Akash, anything?
Nothing. You all have been extraordinary participants today. Thank you very much, and have a wonderful week ahead. Thank you, Jagan, and thank you each and every one of you. Had an awesome session with you all. Thank you.
Thank you, Akash. Thank you, friends.